All right, let's talk about the AI gold rush. We all see the mind blowing tech, but behind the scenes, there's an equally incredible financial story going on. We're talking massive valuations, some very clever accounting, and what really amounts to a masterclass in financial engineering. Okay, let's dive right in. This quote from AI consultant Vishav Preet, man, it just perfectly sets the stage, doesn't it? It hints that maybe, just maybe, not everything is as it seems. There's this complex financial dance happening where money seems to move in circles and massive debts just disappear. And that's the big question for us today. We see the headlines about explosive growth, but how is it all really being financed? We're going to pull back the curtain and break down the specific gears and levers that are fueling this entire boom. So, first up, we need to get our heads around this concept called the Great Money Loop. Think of this as the engine room of the whole operation. It's how capital gets circulated within this surprisingly tight-knit little ecosystem to make it look like there's this massive widespread demand. Here's how it works. You've got tech giants like NVIDIA and Oracle, and they're pouring billions of dollars into AI startups. So far, so good. But then, those same startups turn right around and spend that exact same money on GPUs and cloud services from, yep, you guessed it, the very companies that just funded them. It's this perfect closed loop. The same dollar gets counted once as an investment and then again as revenue. It creates this illusion of incredible organic growth. And this is where things get a little unsettling. The source material draws this really powerful parallel to the 2008 financial crisis. Back then, the key asset being bundled up and traded was mortgages. Today, it's GPUs, the chips that are the lifeblood of AI. Now, the methods are different, for sure. We're talking circular funding instead of complex derivatives. But that pattern of building enormous value on a single class of assets, it feels just a little bit familiar. And that's the punchline right there. The very thing you need to build AI, all that computing power, is being bought and sold in a way that creates this artificial sense of demand. It makes it really, really hard to tell how much of the demand is real and how much is just the money loop doing its thing. Now, this money loop, it doesn't work alone. It's got a pretty clever partner in crime. We're going to look at the financial tool that performs what is basically a magic trick, making huge amounts of debt and risk just vanish from a company's books. It's called a special purpose vehicle, or an SPV. You can basically think of it as a separate little shadow company. It's created for one very specific reason: to hold assets and, more importantly, to hold debt. By shifting billions of dollars in loans over to an SPV, the main company's balance sheet suddenly looks way healthier and a whole lot less risky to investors. Okay, so let's walk through it. An AI company wants to buy a ton of super expensive GPUs, but they don't want all that debt on their books. So, first, they create an SPV. Then, the SPV goes out and borrows the billions. The SPV uses that money to buy all the GPUs, and then, here's the key part, it leases that hardware right back to the original AI company. See? The AI firm gets all the computing power it needs, but the debt, it stays neatly tucked away on the SPV's books. I absolutely love this analogy because it just cuts through all the jargon. It really is like setting up a shell company, your alter ego, having it buy your house, and then you pay it rent. To the outside world, you look great. You're just a renter with no mortgage debt. But you're still the one on the hook for the whole setup. It's a really slick piece of financial choreography. And get this, there's another layer to the game: geography. US export controls mean you can't sell the most powerful AI chips to certain countries. So what's the workaround? Well, a company can set up a shop in a friendly country like the Netherlands. In this case, a firm called Nebiice used its base in Amsterdam to legally buy top-of-the-line NVIDIA GPUs. Then it could lease out access to that computing power to customers in markets that NVIDIA couldn't sell to directly. All of a sudden, a company's mailing address becomes a powerful financial tool. Okay, so we've seen how all the money is moving around. But what does all this financial wizardry actually lead to? Well, it creates this fundamental disconnect, something the source calls the profitability paradox. Because for all of AI's incredible technological power, turning it into actual real-world profit is proving to be, well, incredibly hard. Just look at this chart. This is genuinely staggering. For all the billions and billions being poured into GPUs and AI development, a whopping 80% of corporate AI projects never even make it out the door. They never become a real product. That is a gigantic amount of money being spent with zero return on investment.
And that right there is the heart of the paradox. You've got technology with almost limitless potential, but very little proof of widespread profitable use. And floating between those two things is just this vast ocean of money, all of it chasing a future payoff that starts to look a lot less certain once you see how the sausage is made.
So where does that leave us? Is it all just doom and gloom? Well, not exactly. The argument here is that the path forward isn't about stopping innovation, but about changing the kind of innovation we're focused on. It's about a big shift away from financial hype and towards something a lot more sustainable. This slide just lays it out so clearly. You've got two potential futures for AI. On one side, you have financial engineering. That's all about creative borrowing and chasing those sky-high valuations. The goal is basically to keep the bubble from popping. But on the other side, you have smart engineering. This is all about creating measurable business value, demanding a return on investment, and building AI that's explainable, profitable, and ethical. The goal here is completely different. It's about making AI truly transformative for the long haul. But here's the most important takeaway. This isn't necessarily predicting some dramatic 2008-style crash. The thinking is that this is more like an inevitable market correction. Eventually, all this financial froth has to settle down, and the industry will have to mature. The hype will fade, and the focus will shift to what actually works in the real world. And that leaves us with this final crucial question. When all the dust settles, when the financial engineering gives way to smart engineering, who's actually going to be left standing? The smart money says it won't be the companies that were best at playing the financial game. It'll be the ones that were focused on building intelligently and delivering real, tangible value from day one.